Hello, I'm Chad, and welcome back to your Banking and Credit Toolkit. This will be the final episode in our series of cool financial tools you can use. In today's episode, we'll learn about credit scores, what they are, and why they are important. Are you ready to find out? Me too. So let's get started. When people work, make money, and pay bills, almost everything regarding spending and debt gets reported to a credit agency. A credit agency keeps track of your credit history because businesses want to know if they should do business with you. If you are not good at paying monies back, why should another business extend credit to you? They don't want to chase you to get paid, neither would you in their shoes. But if you have a good credit history and you are reliable with a good credit score, you will find that the money doors are open. So a good credit score can be a great financial tool for you. There are three primary credit reporting agencies: Equifax, Experian, and TransUnion. And they all have a slightly different way of rating your credit score. Each of these credit reporting companies will have a different credit score number. This is because they all look at the same things, but in different ways. But for all of them, having student loan debt, credit cards, or a mortgage is not considered bad debt as long as you make payments on time. You are showing a good payment history. People with credit cards have what is called a revolving account because the payments aren't fixed since the spending is different, or revolves each month. If your credit card is paid every month, that also shows a good payment history. Just like making your house payment or rent, it raises your score. These credit reporting agencies receive reports from banks, credit card companies, mortgage companies, or any business where people have loans. This includes home loans, student education loans, car loans, credit cards, and things like that. You want your payment history to be as good as possible. It is good for a young person to start being guided by a parent on how to manage your credit and maintain a good credit score. When you make all of your payments on these loans on time without being late, your credit score goes up. A good credit score is over 650, and a perfect credit score is 850. Anything in between is a good score, but any score over 700 is better. The higher your score, the better or lower the interest rate you can get on any kind of loan. This is because credit scores tell lenders, the people you would borrow money from, how much of a risk you are in repaying loans. Many things go into your score and being considered for a loan. They look at things such as your job, how much you make every month or every year, if you have been late paying for things, if you have any bankruptcies or foreclosures on a home. Do you know what bankruptcy means? People file for bankruptcy when their debts greatly exceed their assets, and they see little hope of reversing that situation anytime soon. A bankruptcy filing is intended to provide breathing room for individuals to get their affairs in order and usually to develop a plan to pay creditors. Bankruptcy is one of the worst things that you can do to your credit. A bankruptcy is like an F on your credit report and can affect your ability to use credit again for up to 10 years. But we want to give people a second chance, and bankruptcy does that. One thing about your credit score is that every time you apply for a loan, apply to rent an apartment, or sometimes apply for a job, setting up utilities, joining a credit union, getting car insurance rates, they will look at your credit score. This gives them an impression of how reliable you are and how well you handle your money. But every time someone looks into your credit score, it can drop your score a few points. That is because it shows activity, which is negative. You can lock your credit score from being looked at without permission, which will help raise your score. Some people will just look at your score without you knowing about it, which is kind of creepy. Some people have bad credit scores due to things happening that are not their fault, like losing a job, going through a divorce, or having high medical bills, which also affect your credit score. Your credit score is one of the most important things you will ever have as you become an adult. It is like a report card on your life. So you need to protect it. It will make your life easier later in life. So to maintain a good report, you need to be prudent over all your finances. Being responsible with money and paying bills on time will give you a great credit score. Of course, when you get older, you will look at other people's credit reports to see if you should or shouldn't do business with them. So a credit report is a really good tool for you to use when you get older too. In this series, we explained everything you need to know about bank accounts and credit. The essential financial tools you will need to use in your personal life, starting now and in the future. And I know you'll be wise about your money. Thanks for joining us. I hope to see you again as we continue to look at things we all have to be aware of in our lives. I'll see you soon.